Myth: I am rich, I don't need life insurance. Habits that create wealth. In 2014, Guinness World Records confirmed a new record for the largest, most valuable life insurance policy ever, valued at $201 million or 1,655 crores approximately, issued to a well-known US billionaire. According to Guinness World Records, the $201 million policy more than doubled the previous record for a life insurance policy for $100 million or 823 crores approximately set in 1990 for a policy on the life of Hollywood mogul David Geffen. He founded DreamWorks Pictures with Steven Spielberg, and the person who sold it was Peter Rosengard from the UK. Now let's see who the $201 million man is. A well-known, unnamed Silicon Valley billionaire set a record with a significant coverage amount to protect his wealth once he is no longer around. And the $201 million policy would be paid out upon the buyer's death. This is not a term life insurance plan. The record-breaking life insurance policy was sold by Dovey Francis, a managing partner of Santa Barbara-based SG LLC, a firm that advises high net worth clients on their complex financial needs. The $201 million policy is more complicated than most policies. No single insurance company holds the $201 million risk. The life insurance policy is actually 24 policies underwritten by 19 different insurers, and the annual premium is more than $20 million or 164 crores approximately every year or so to spread out the risk. Guinness officials spent 6 months investigating the policy before declaring it the world record. The insurance companies benefit from the deal by immediately investing the premium. Dovey was not legally permitted to disclose the name or age of the billionaire buyer, but said it was a well-known Californian tech investor. Dovey said the billionaire wants to remain anonymous for two reasons: privacy and keeping the news from his benefactors. Why would a billionaire or anyone spend so much on a life insurance policy? How can we build wealth with life insurance? As quoted by Robert Kiyosaki, it's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. We go back to the financial planning pyramid. Life insurance works bottom up from wealth protection to wealth accumulation to wealth distribution. Life insurance enables one to create and build one's financial tower stronger and higher with the strongest foundation, that is wealth protection, and works at wealth accumulation level of the financial pyramid and right to the top with wealth distribution. It works for everyone, not just the millionaires and billionaires. There are several unique reasons that someone may consider purchasing it. How does one start the wealth building process? For high net worth individuals, one reason for accumulating wealth may be a desire to keep it in the family by passing along assets to future generations and shield it from taxes. What many people don't know, however, is that death benefit is just one element of life insurance. It can also build wealth through the years while we are still alive. Life insurance is a popular way for the wealthy to maximize their after-tax estate in the wealth building process and have more money to pass on to heirs. A life insurance policy can be used as an investment tool. Tax planning. How the ultra-rich use life insurance to reduce taxes and increase returns. cash value life insurance or whole life insurance, perpetual uninterrupted compound interest, which employs triple compounding to earn compound interest in a tax deferred account because taxes destroy compound interest. This is the living benefit of life insurance. Debt management. Married Women's Property Act of 1874. Section 6 of the Married Women's Property Act 1874 provides that a life insurance policy that has been taken out by a married man on his own life for the benefit of his wife and children shall be deemed to be a trust and will be outside the control of the life insured, his creditors, or court attachments, etc. For example, Cafe Coffee Day, stock exchanges, and Ministry of Corporate Affairs filings had unraveled that deceased Cafe Coffee Day promoter V.G. Siddhartha, the Coffee King of India, may have been under an enormous debt pile of up to 11,000 crores. The liability of an individual is recoverable even after his or her death, and as per law, the estate will first have to pay off all the liabilities of the deceased before distributing it to the beneficiaries. To ensure the financial protection of one's family, any amount attached to the life insurance, howsoever big, even if big enough to cover all the debts, cannot be claimed by wife's relatives, even her own husband cannot claim it, or the creditors, or by the courts. So one can ensure the financial protection of the family by buying a life insurance policy under the Married Women's Property Act of 1874. Loan against insurance policy. Policy loans provide a source of funds that uses your policy's cash value as collateral. You don't need any physical asset as collateral to secure the loan. You must have accumulated cash value or must gain a surrender value in the life insurance policy to get a policy loan. Please note, a life insurance policy loan isn't taxable as income as long as it doesn't exceed the amount paid in premiums for the policy and the policy remains in effect. Options for repaying your loan include paying only the annual interest or making periodic payments. You don't need to pay back a policy loan before you die, but the balance will reduce the death benefit. Estate equalization benefits. Estate equalization is the process where one's asset is passed on to one child and an asset of equivalent value is passed on to the other or others. The method of providing this asset of equivalent value using life insurance is a practical solution to equally divide assets and pass to the next generation while preserving long-term family harmony and business continuity. Benefits of estate equalization using life insurance. For beneficiaries, maintains trust and confidence amongst beneficiaries by preventing family dispute over inheritance. Provides financial security for beneficiaries who are not interested in the family business. Provides liquidity to make payment to heirs who are not active in business, thus avoiding the need to liquidate the business. Effectively increases the value of the assets that can be distributed among heirs. Benefits for business. Protects the value of the estate by avoiding the sale of the business. Promotes long-term value creation by minimizing business disruption. Facilitates the continuity and growth of the family business since it does not need to be split between beneficiaries who may not be interested in the business, and supports succession planning. Inheritance tax. In many countries, the heir must pay inheritance tax for inheriting any such property or assets from your parents or grandparents or any other relative or friend. There is talk about India reintroducing inheritance tax. One will be liable to pay tax on properties, jewelry, shares, fixed deposits, mutual funds, cash in bank, along with physical assets inherited. Life insurance is a popular way for the wealthy to maximize their after-tax estate and have more money to pass on to their heirs. The insured probably has assets of sufficient value to draw a sizable tax and justify the need for insurance. A wealthy estate may get a hefty tax bill and there may not be enough cash to cover it. Waterfall or Rockefeller life insurance strategy. The Rockefeller formula and how overfunded life insurance make you more tax-free dollars, adding value with tax-efficient planning. The name comes from John D. Rockefeller. The most tax-efficient way to purchase a life insurance policy would be an irrevocable life insurance trust. Irrevocable life insurance trusts allow individuals to ensure the benefits from a life insurance policy can avoid estate taxes and follow the interests of insured. The Rockefellers used a series of irrevocable life insurance trusts that helped pass down wealth to future generations. And John D. Rockefeller's great-great-grandchildren are still getting paid off the legacy he set up more than 100 years ago. Irrevocable trust refers to any trust where the grantor cannot change or end the trust after its creation. These trusts both fund and remain funded through premium life insurance policies and include strict stipulations that protect the family from the risk of irresponsible behavior. The estate planning strategy in which a whole life insurance policy is transferred or rolled over from the policyholder to their child or grandchild in as tax efficient manner as possible. Charitable giving. The wealthy enjoy giving back and supporting good causes. Many of them believe that as accomplished, successful individuals, it is their duty to give back. Life insurance pays a tax-free death benefit when the person whose life is insured dies. Before I conclude, there have been a lot of myths around investments that we have grown up with. Life insurance can offer numerous benefits regardless of net worth or wealth accumulation. While the reason behind choosing life insurance may be different for different people, the need of life insurance remains constant. The proceeds can be delivered with interest that is continuously compounded over a period of time without any breaks or interruptions for the beneficiaries. Are we ready for whatever life throws our way? May the force of protecting wealth for future generations be with you. Please go through the description for the sources for this presentation. I've shared the link to my next presentation, Myth: Housewives or homemakers do not need life insurance, at the end of this presentation. And do not forget to check out the playlist for more presentations. If there is something to gain and nothing to lose by asking, by all means ask. Thank you for taking the time to watch this presentation. I sincerely appreciate it. Namaste.